Welcome to the Broken Pie Chart Podcast, episode 305. I'm your host, Derek Moore. With me once again is my co-host, Jay Pestrichelli. Jay, what did you do to the bond market? You uninverted the inversion.
Well, it only took me, forever to get it done. But yes, the wrong Jay in this scenario. But finally, last week, it's the other Jay, pal. The other JP. The other JP, right? We could say that.
Yes.
But finally, after, how long did we have this inverted yield curve? We are now no longer inverted on the 10-year versus the 3-month? That's kind of the standard.
And that's the Cam Harvey one. That's the original one he wrote the papers on. That's the one that matters. Yeah,
10-year minus the 3-month treasury. And so now this means the 10-year rate is finally higher than the 3-month rate. It's been a long time coming, and this is and why does this matter? Like you just referenced, this has in the past been a predictor of recessions. The inversion has been a predictor of recessions. Derek, have we had a recession since this inverted?
No, and what was it? October of 22, I think. So until December.
Over
October
2 years.
Yeah, according to Charlie Bolello on Twitter, the S&P was up 62% during the inverted yield curve, October 2022 to December 2024. So, Jay, no recession.
No.
But now we have the recession, right? It's coming?
Well, yeah. So recession is coming. I don't know if it's 1 year or 10 years. Recession's coming. We will eventually have a recession, of course. But I would say, this was like a man-made situation. When I say man-made, it was, Fed created all of the, and I'm not going to use the M word because I think they were, I'll use the managing word. They were managing rates. They weren't doing the manipulating rates. I think that it was kind of forced because of certain circumstances, a pendulum swinging dramatically one way to the other with going to zero for the pandemic and flipping the other way, raising at historic rates to combat inflation. So, I'm not surprised if this eventually becomes the exception to the rule that we just experienced. But the fact that, it's been 2 years, there hasn't been a recession, it just goes to show there's no rule that's absolute when it comes to investing. You have to take everything for whatever the circumstance is. And that obviously sounds pretty no brainer. But the point is, maybe now there's freedom for the recession to come. Maybe now we could start the clock. And in the past, it was always when it inverted, it had the recession. I don't know. But look, it's the inversion right now happens to be over. Rates are rising. Derek, you and I talked about this, and we told everybody, you should expect rates to go up as the Fed is cutting. Now, we said there's a chance that could happen, and that's actually what has happened, right? So the reason this un-inversion, reversion, this normalization of the curve, is happening, has a lot to do with, policy and kind of what has been going on here. And you would have thought, everybody was thinking, well, Fed's going to cut rates, interest rates are going lower. Nope, that's not what happened.
The Fed caused the inversion and they caused the un-inversion. They did it. It wasn't market forces.
They move short-term rates, right? The way the 10-year reacted was the market reacting, going no, this will be over. No, this will be over. No, we can't have 10-year rates at 6.5% when Fed funds is at 5%. No, don't worry. And the market just wasn't believing that higher rates were coming. And so it was stubbornly low, which is what drove that inversion, right? Because Fed's going to do what the Fed's going to do on short-term rates. How that ripples out to the rest of the durations is up to the market to determine. And the market just wasn't buying that rates should be as high as the Fed was putting them to.
Mortgage News Daily had a chart, and I am not familiar with this organization. They have a logo, so I assume they're
it's fun. There's a little Earth in the a globe, and the O in mortgage is a globe.
So are they global?
I guess maybe they're global mortgage.
I don't know. Well, anyway, so September 18th, the 30-year mortgage rate was at 6.11. at the time I grabbed this chart, 7.14. Total Fed cut, 100 basis points. We're up plus 100 basis points in the 30-year mortgage. Jay, you pointed out as well, same thing, 100 basis points of cutting. The 10-year treasury yield up over 100 basis points. And I will mention 1995, from July of 95 until July of 96, the 10-year went up 100 basis points on only 75 basis points of cutting. So it's not quite, I keep saying, well, 94, 95, it's the same thing. Not quite, because we didn't cut 100 basis points. But Jay, you had sent me that chart, and we've seen this before. But barring a recession, you would think the 10-year should go up because you think there's going to be growth.
Yeah, it's going up for different reasons. And if you were, waiting for the Fed to cut to redo your mortgage or refinance, you missed it. Well, for now you missed it. It may go down in the future, but for now, rates are 100 bips higher than before the first cut. It's crazy, right? So it was all this. It's it goes back to the market is kind of anticipatory, right? It's leading. Right, the market is usually ahead of things. We would always say the equity markets is usually 6 months ahead of what's happening in the economy. Look, the bond market is also going to, be predictive in nature, and it's predicting higher rates right now. I mean, it's reacting in a way, I should say, that we actually have higher rates than before the first rate cut. So again, just, I know it's one of those things that it seems kind of backwards, but the market has a habit of doing this kind of stuff all the time, right? Nobody knows where rates are going to go. Nobody knows where the market is going to go. Derek, I remember you and I had we were doing a presentation around this time, and it was August, I think, June or August, to a company, and we were presenting to them like a bond portfolio, and I remember the reaction was, well, your duration is too short. Rates are going down. You don't want to be stuck. You're going to have to, get higher rates or worse rates later when these mature. And we said, you don't know where bond rates are going to go. And they said, everybody knows rates are going down. I really feel like we should call them that, just to say like, hey, we're still here to help. If you guys still want to get some direction. It's one of those things, you don't know where the market is going to go. Anything that you think is already baked in the market, period, always. So, it's just one of those things. Don't always count on, well, this is what the trend is happening. You just don't know what's going to happen. And this
I remember other people, Jay, saying, well, everyone knows they're cutting, so shouldn't you just buy longer duration bonds? Like, that's probably the easiest thing to do. And I said, if it seems easy, it's probably not. And you have no idea what's going to happen to the long bonds. You just don't. And the Fed funds futures were already reflecting. I mean, here's an interesting thing too. Even if you said, okay, and I'm not saying anybody should trade Fed funds futures, but let's say you were like, oh yeah, I know they're going to cut. So I'm going to, I got to think about this, because it's 100 minus the Fed funds futures, the implied rate. So if you think, so you'd buy those because you want the price of the future to go up. Okay, anyway, imagine you did that and you still lost money because they haven't cut as much as that was factored in. Yeah. So even on the short end, it wasn't quite clear. I probably confused the heck out of everybody there, but
me too. But that's Google okay. You just look. I think the point you bring up, it's the same one. Like, you just look, if you think something, there's no guarantees here. You certainly can have an inclination, and sometimes you end up, being in a trade a lot longer than you expected because what you expected to happen didn't pay off, or didn't actually go the way you wanted. But it's one of those things. It's difficult to predict markets. It doesn't matter if it's equities, doesn't matter if it's commodities, doesn't matter if it's bonds. Markets are difficult to predict. There's a lot of factors you can't see coming.
All right, we're going to get into, now we just said we can't predict it.
Let's do predictions.
Give you some predictions in a little bit. Not yet, but we're going to give you our 2025 predictions that I'm sure will be wrong at some point. I do want to mention some commodity markets. Cocoa is going cuckoo again. It's going. I think it's. Oh, I don't know if it's back up at the old highs. Remember that one was running for a while. We talked about coffee futures. I think at an all-time high. Certainly, crude oil futures are nowhere near an all-time high. Here's one, Jay, and I know the audience loves talking foreign commodity markets. Rubber futures, which trade in Japan on the Topcom commodities exchange, kind of surging. They're making a new high. Then most of the trees, rubber trees, come from Southeast Asia. So I know I got about a half hour of material on the Topcom rubber futures market. You ready?
No, definitely not. Okay. No.
It's
look. The point is, commodity markets. You see, there's certainly plenty of commodities. You just rattled off three of them that are pressing highs and moving up higher. But commodities are getting more expensive. Is that related to the dollar? Is it related to supply and demand? Like, help us out here. What's driving these things?
Well, I'll come back next week with some good information on the I think it's weather in this case, but it could be the dollar too. Could be the dollar. I did have a couple before we get to our predictions, and then we have more content as well. But we have some comments that I've been keeping. One from Joanne. Is Santa giving us this lump of coal for Christmas instead of the Santa Claus rally, Jay?
Well, it feels like it, right? We've had a couple down days here, right? We are not. I mean, the last time we made a new high was December 6th, and it's December. The Friday we just had was December 27th. So doesn't look like we're going to get that rally. Look, it's not always a foregone conclusion you're going to get a Santa Claus rally, which, by the way, can't happen technically right until after Christmas. It's that week between. I don't know, Derek. Like, it's certainly not great. The market feels like it's a little heavy right now. We talked about this, I think, last week that, people are thinking about taking off gains. Typically, they wait till January to let gains or losses kind of flow to the next year. They've done their trades for the year. They usually sit tight. But I think we've had, two strong years in the markets. And if people want to just take some off the table, it seems to be, it's okay. It's all going to be long-term cap gains regardless. I don't know if it's all going to be that, but, if you bought NVIDIA in June of 2023, hey, that's already a long-term capital gain. So that's just one of those points I'm just bringing up. Like, it felt like after the meeting, right, after the Fed meeting, it definitely put a wet blanket on the market, and there's no news. We're not going to get anything until what? We're going to get some unemployment. I don't know when that's coming out. I should have looked before I brought it up. But that's probably is it January 3rd or January 10th? Sometimes they move it when you got the holiday in the week.
Yeah, you know what? We're recording this on a Saturday. I don't have my normal setup here.
Yeah. So, I mean, there's really no news until, we get to like earnings.
Yeah.
That's still a ways away. So my answer is feels like no, wet blanket time, probably lump of coal from Santa.
It's a little lower volume too. That's the thing too, which
sure.
All right. Kakashi. Yeah, we got like three of them. And somebody trying to sell me some sort of wallet, Bitcoin.
Oh, a Bitcoin wallet?
Yeah, I don't know what's going on there.
I couldn't think of a worse target to sell that to. That's good.
Yeah, well, especially me. His comment was, thanks for dumbing down price to sales. I am new and young, so thanks. You're welcome. Thanks for listening. And then Boy Seabits. So these are on some of the YouTube. So that's why you have the usernames. If we get emails, you can send those, derek.moore@zegeinvestments.com. That's Z as in zebra, E as in Eddie, G as in George, A as in Apple. You got to learn to spell investments on your own. And Derek, DEREK.MOORE. Okay. And email us too if you want to know how we can help you manage your portfolio or see some of the ways that we're hedging. All right. But anyway, he said, how can you say, I think this is directed to you, Jay, how can you say we have landed, in quotes, when the Fed still has their fingers in the pie? As long as they are adjusting then they are not done, and hence you cannot call it over yet. Don't be a Fed fanboy. And there's like a crying smiley face, Jay. I think that's directed at you.
Yeah. Well, the risk of the recession is like, that's the point. It's like, we didn't have the recession. That's why I said, we don't even land. Like, it's over. Like, the Fed manipulating, this is, kind of insinuating that the Fed is manipulating rates. I don't think so. I think the Fed's doing what the Fed's going to do. So maybe that's why. And I legitimately asked the question. I didn't understand why people were still asking, we're going to have a soft landing. So then what, hard landing, soft landing. So what? When is the Fed not got their hands in the pot? Like, when is it? Like, you think we're going to go back to 2%? Is it 3%? Like, at what point do you say they're out of it? I don't know.
Well, maybe it's when it's only evident after the fact, but you can say, well, they've stopped raising or lowering rates for a certain amount of months. Maybe that's it. Like, they're not doing anything.
Listen, I fair enough if that's what it's going to take for us to decide if we've, soft landed or not. But I don't know. It feels pretty damn soft to me.
All right. Well, that's, keep the comments coming.
Market's been rocketing the last 2 years. Yeah. But if it's because the Fed is manipulating it, I don't know.
I manipulate is a fair word, because, like, if you were, I don't know, threading a needle, you'd be manipulating the needle into the thread, or, maybe it insinuates something.
They've got a dual mandate, right? We know they're trying to manage unemployment and they're trying to manage inflation. So, yeah, they're going to move things around.
Go back to our prior shows, too, where both Jay and I say they didn't need to even raise rates. They could have done nothing. And eventually we'd be at the same place.
Yeah, it would have fixed itself. Yep.
On inflation.
Yeah.
All right, let me go to predictions. So the disclaimer here is don't do any of these trades just because we say this. But we Jay and I, and then a number of our traders, so Mike Puck, who many of you know is a semi-permanent co-host. He's been on the program. He'll probably be on again in January. We'll talk about that later. But we fill out a prediction, and we kind of look and say, what are the markets going to do? What are interest rates going to do? The economy. Have a little fun with where Bitcoin's going to be. So let's do this, and then I know we want to cover some VIX stuff, and we got to talk about China too, whether that's a problem or not. So, Jay, tell me first. You want to talk about the market? Where do you see the market?
Yeah, I think that's probably the most interesting here, right? So the average across the 1, 2, 3, 4, 5, 6 predictions that we had landed us at end of year next year at 67.66, which I think, Derek, you said is about 13% higher from where we were.
Yeah, 13% higher.
Double-digit growth based on the average. The range is really, it's fairly tight here, right? There's nothing ground shaking. Somebody came in at 69.95. The low is 6,500. So, 500 point swing, landing right in the middle at the 67.5 range. There are some lows. I like to talk about the highs and the lows here. The highs aren't much higher than where we end. Most folks have us ending close to the high of what they predicted, but the lows are more like the average is 5,600. So, that's only 350 points lower from here. So this is a fairly bullish outlook from our team, huh? Yeah. And they're all pretty tight. Somebody who's got this low at 6,000, but everybody else is in the 55s, 54s, 57s. So fairly tight market. I mean, this is a recency bias, in my opinion, right? It's just the natural thing that people do. Again, I don't think there's a ton of research that goes into each one of these data points. We're just asking for the predictions from everybody. We purposely don't give them a lot of time to do it. We try to get as close to the end of the year as we can.
That's right.
Where there's a lot of dispersion or difference of numbers is in volatility. So you never really ask, where is volatility going to end? It's really, where is the VIX peak, right? That's always the kind of the scary thing that you want to be on the lookout for. And this is very, very wide, right? There's you and I came in very close at 40, 41. The average is 48, but that is skewed by someone that put it in 90. if we have a 90 VIX at some point during the year, I think that'd be pretty volatile. I think he was going for a shock number on that. But if you take him out, you're in the 40s, 60s, really, but still a decent range. We're going to talk a little bit about the VIX on what happened this past year. But, remember we touched the 65 at some point on August 5th of this past year. So that was, looks like somebody, took a cue from that and came in at 66. So I think those are kind of some of the big numbers here when it comes to the market, equity markets, and volatility. You want to take, you love talking about interest rates. You want to talk about those?
Yeah. Well, I think it's, when I look at interest rates, it's two parts. One, what the Fed's going to do, and then what's the 10-year. We use the 10-year yield. And, I'd say on average, it's really, this isn't going to make sense. 395 to 415, the end of year Fed funds target. And there's no way that would, unless they start doing, 15 basis point cuts or, but let's just say 4 to 4.25, if I round, is sort of where, you think things are going to be, which implies about another quarter point lower. I don't have them making any changes next year. So I have 4.25, 4.5. You are 4.25. So you have 125 basis points. So you're right about the average of the team. Somebody has a raise, 4.5, 4.75. He's also the one who said 90 VIX. So maybe that would, a shock raise would cause. I
think I threw a raise in there, Derek, didn't I?
Unless I read it wrong. Oh, you did. You said the high range. That's right. Yeah. You have it going up by a quarter point and then coming back down 50 basis points.
I've got a roller coaster ahead.
Yeah. Oh, I like it. And then on the 10-year yield, I'm at 5.4. The people we polled are 5.12, right about 4.6 right now. And the end of year average is right around 4.7. So kind of ending the year right about where we are. I think I'm the high though here. It looks like, someone else has 6%.
Yeah. That's the guy with the high VIX.
Yeah. That's, to me, all right, can I tell you how I just did this? I think the mortgage bond market's been right. And if typically it's 170 points, 70 basis points difference between the 10-year yield and the 30-year mortgage rate, we always say, does one have to come up to the other? Does the other have to come down? And everyone's assuming that mortgage rates have to come down. I think the 10-year has to go up. And so I said, if we're at 7, 170 points less, 70 bips less, right around 5.3. I just said 5.4. So, but
okay.
Yeah, we sort of have, it's pretty clear, not going down. And some people think the 10-year is going to go a lot higher. And then we're sort of mixed on the Fed. Inflation there's some dispersion there, both in inflation and GDP, Jay. And by the way, I'll just cut to the chase on recession. Nobody has a recession happening. But what do you see on inflation and GDP?
Generally, so 2.4 is kind of the average inflation everybody's predicting. There's some, there's a lot of 2 3s, and then there's a low ball in there, different guy. So actually going down from where it is today, and GDP is coming in at about 3%. Most are in that 2 to 3 range. There's 1 or 2 little high balls in there. Someone's got a 5%er in there. Same guy who said 0% inflation. So what did he pick as his S&P high? He was on the high end. So 0 inflation, 5% GDP change. Yeah, that'd be an interesting year if that happened. But anyway, yeah. So average at 3, and then on GDP, and average on inflation 2.4. Let's call it.
Yep. EPS. Looks like the average is 281. I came in at 298. You came in at 300.
I Price is righted you there. I got you.
I actually think there's a possibility. Well, the dollar could, I think I didn't do like 310, 315, although I think that's possible. because the dollar index, and the dollar index being higher is going to take away from some of those. You have it going down to 95. I have 116. The average is 110. Oil, I think the average is 75. We'll kind of go through some of these quicker. And of course, I'm the lowest on Bitcoin. Like if you take me out, the prediction's probably like 175,000. I think I'm 50,000. You're 200,000. End of year Bitcoin price. So
and I am not the high on this list. So we'll see.
That's surprising.
Yeah.
I mean, gold, the average is 2908. This is it's a good example of sort of groupthink too. The fact that we're all so close.
Yeah, everything is really jammed in together here. So, here's the one thing I would say is nobody's really predicting. Well, there's one or two little outliers here. The rest of it is all together. Groupthink is usually not right. So I would say dismiss everything we just told you. It's probably all going to be wrong.
Yeah. Like I was thinking too, like if I was going to say, here's a trade that you shouldn't do and probably won't work. But I was like, synthetically short either the 10-year ETF, 10-year bond ETF, or, so what is it, IEF or TLT, maybe longer duration. But you synthetically short it. So using a put option and selling call. Don't do this trade, really. This is just like I'm making this up. And then you got to pay the carry cost because that dividend is implied in the put. So then maybe you buy like Bill and you synthetically short. And so the interest from Bill covers your cost of carry on the other one. And if it doesn't work, well, I mean, you could lose money there because you're not going to get protected on Bill. That's a trade that probably won't work if I'm thinking about it.
So you're saying short the longer duration, own the shorter duration.
That's right, because you use the shorter duration, the interest to pay the carry cost on the synthetic. So,
believe it or not, like I'm looking at TLT 1 year out. Like let's say, I could only choose November or January. So let's look at January 26s. Right, it's about a year out. So you look at the 87s. You sell the call for $6. You buy the put for $5. So you get a net dollar on that. And if TLT goes down, you're participating on the way down. So you actually, Derek, you don't have a break even on this because of the dividend here. So actually the dividend is outpacing the cost to carry. So I didn't know if you'd realize that. So if you wanted to go long that, there would be a cost. You're shorted, so you're getting a credit on this. And then if you own Bill, you're going to get the short-term rate, which is like what, 5%, just under 5%, right? 4.5% right now, I guess.
4.5%.
So yeah, and if you do get rates, if you do get TLT dropping, if it continues to drop, which by the way, if you look at that chart, I was looking at it on a 3-year basis the other day. I don't know if you've seen a chart of TLT on a 3-year basis. We are at kind of a low. We're approaching, we went through the low that we saw back in April, and now we're going to start approaching the low that we saw in October of 23. But actually, if you can go out even farther than that and you go 10 years, you have this huge kind of triple bottom thing occurring here. So I don't know, it feels like there's more to go down on TLT if you're looking at that chart, right? If you really want to get down. But TLT is in a series of lower lows and lower highs. Being bearish TLT here, which means higher rates, there's an argument for that. And you could do it in a way where you get like a free dollar head start while you're waiting using that synthetic short. So that's interesting. And the synthetic short, again, is buy a put, sell a call at the money, or the same strike.
The risk there is you're essentially short. And if interest rates go down, the TLT has a longer duration, means greater sensitivity to changes in rates. So you'll get hurt if rates go down and that goes up. And there's other ways you could buy a call higher to sort of, I don't want to belabor it, but there's ways you could hedge the synthetic as well.
Yeah,
because
your unlimited risk is that short call, right? And so if you look at the chart and you say, okay, if I'm going to get a free dollar, can I use that dollar to put on a hedge? You'd have to go all the way to like the 110. So you could limit yourself spending that dollar you get from the credit and just buy that 110. So, your worst case scenario is you ride TLT from 87 up to 110. So that's what they're $23. Not great. You'd lose quite a bit of money on that trade if it did go, but at least you'd be hedged. Meanwhile, you're earning 5% along the way, but you just lost 20 plus. So still not a great trade if it goes up on you. If TLT keeps going down, which means interest rates going up, then that arguably could work.
The time to do this would have been September 18th. Like you're not early to this trade. So
No. This has kind of happened. So I'm just curious, looking at IEF, which is the 7 to 10, which is a little closer to what we like to talk about on the 10-year.
Yeah, and that's probably safer from a risk standpoint, because if it goes against you, there's not as much sensitivity to rates. Different part of the curve.
Yeah, and that one, in that scenario, Derek, you, again, get a slight credit in that scenario. So, buy bill as your collateral, do the synthetic. And in that case, by the way, that's also kind of, it hasn't really breached the low that it saw back in April, May. So it could have some more downside. IEF looks like a little head and shoulders going on there. So, if you were a chart guy, you would say, there's a chance that this goes lower. But you're right. The time to have done this was, going into the September meeting before the Fed started cutting. And you would have, this trade would have worked from 99, let's call it, all the way down to 92, where it is right now. Meanwhile, you're earning, 5% on the bill position. So, and it's, you're right. It's late on this trade, but if what you're predicting that, 10-year continues to go higher in the yield on the 10-year, this trade works for you.
Yeah, don't do the trade, but it's a little insight into off the cuff how we're kind of thinking about it. Well, how do we pay for it? Where's the risk? There's those types of things. All right, I'm going to come back to some of the off the wall predictions. A couple things I want to cover though first. One is, we don't have to spend too much time on this, but somebody had a graphic that showed the difference between the VIX spot index and the VIX front month future, the active future, was the highest it's been since 2020. And look, the VIX it's not a trading vehicle. So you can see the VIX go to a level where things have never traded. It's based upon,
it's an equation.
It's bid-ask prices all up and down the chain. So what I did was I said, well, let me take VIX index plus the active futures contract. And when you add them together, it in fact was not as high as 2020. In fact, it wasn't even as high as, August of this year, August 5th. So I didn't put the other chart in here, Jay, but I sort of wanted to make the point. You got to be careful when you start looking at, just like we did last week on the percentage change in VIX index. The VIX index doesn't trade. The futures trade, and options are on the future. So we don't have to spend a lot of time on this.
We've spent a lot of time in the past explaining the difference between the VIX that is traded, i.e. the futures, and the VIX that is priced based on the index, which is an equation. So there's definitely a difference there. And there's, when money flows into one like the futures, it tells you where people are actually putting money versus just looking at the academic equation of the VIX index.
It is odd. Maybe December of 18 was the last time we saw a December surge in volatility like we've seen this month. Yeah,
no, that's true. It definitely was elevated. We're definitely seeing, it was a volatile week last week, quite frankly, right? Big up days, big down days. And then the week before you had that wacky Wednesday. So after the, Fed announcement. So Derek, I think, we have talked about maybe going into the year with some, a little bit of fear and volatility. And, the question is, are we doing a repeat of what happened at the end of 2021, which immediately saw a sell-off in January of 2022? Don't know. actually, we don't know to the point that we started rehedging our portfolios, right? So our classic strategy, our classic hedged equity, buy and hedge classic, that got rehedged. And I think, there's other strategies that use hedges that are getting done this week too. So, let's start the year fresh with a fresh set of, downside protection, and, we'll see what happens. It's not like we want the market to bring volatility. Volatility is not good for anybody's portfolio. Even as a seller of volatility, you have to time when the exact right time is to sell a volatile asset. It's hard. So predictability is usually preferred when it comes to investing. And so, but, defining our risk at the beginning of the year seems like for us, makes sense. And if we're wrong, if it was completely not needed, we bought a little extra insurance, but we didn't get out of the market, right? That's where you get burned, where you're trying to time your entry and exit. You've heard it a million times from us before. It's easier to time your hedges, and if you're wrong, it's not, detrimental. Whereas if you get it wrong on when you're going to be in or out of the market, you got to make two decisions right: when to get out and when to get back in. And if the market just runs on you, you'll be chasing it, and you have all this upside missed. And now, if you get it right and the market tanks, it's great. You avoided the loss. The hard part is pulling the trigger when to go back in.
All right, let's switch gears, Jay, and let's go to China. I teased it last week. Wall Street Journal had a chart calling it Deflation Nation. Prices in China, year-over-year percent change. The producer price index, the PPI, which is the input cost, and their consumer price index, their CPI. What you see is it looks like going back to, I'm going to say 1, 2, 3, probably October of 23. They have not had a positive year-over-year change in their own PPI, which means the input costs are in. I
think October of 22, actually, Derek.
Oh, you're right. Yeah, 22. So that would have been, October of 22. CPI has been, it's sort of been oscillating, although the last, I'd say, 8 months or so has been positive, not too much positive. And the reason why this is interesting is because you look at their bond yield. So I pulled a chart of their 10-year government bond. 1.7% is the yield on it right now. And my chart, I can only get it to go back to 2005. I mean, the previous low was really 2.5, and that was in probably March of 2020. It broke 2.5 and then has continued down to 1.7. So you think about our inflation is not 2%. Our PPI is not, it's not 2%. It's we
higher.
Still have. And our bond yields, our 10-year yields are going up, not down. And then you have China doing the opposite. So their economy doesn't seem like it's, they're doing some stimulus and things like that. There's a weird dynamic here, though, Jay, in that everyone is talking about tariffs. And we know that's been in the news. We know people are saying, well, everyone knows tariffs are coming. Everyone knows prices are going to go up. But there's deflation in China, and their financing costs are going down because their yields are going down. Is there a world, Jay, where even if Trump does the tariffs, that because prices are in a deflationary environment, that they can absorb it because their input costs are already going down, their financing costs are lower?
So by they can absorb it, like how would they absorb it, right? So walk me through the scenario where they would basically, in order to keep their products competitive in the United States, they'd have to lower them to the point of what they sell to us pre-tariff, and then post-tariff it comes in at the same price.
Right, but their margin, they preserve their margin because of their input cost.
Right, and they could do that because their input cost is lower, right? So
their financing cost is lower, yeah.
Yeah, I think there is that would be, that's a perfect example of, hey, everybody thinks tariffs are going to be inflationary. Maybe it isn't. By the way, there's plenty of times in history where it hasn't been inflationary, and that's fine. So, this would just be a little different than the last time when there was a little bit of a trade war in 2017. So I think it's just one of those things, Derek, that as it could be a surprise. I think you're kind of touching on something based off of the academic view of what's going on in China with lower financing costs and lower costs of production, that certainly could be the case. I think this could be a really interesting thesis. Nobody's talking about this. This could be one where Derek's first.
Maybe they get to raise their prices too, because the yuan is going down relative to the dollar.
Right.
So think about it this way: their input costs are lower, their financing costs are lower, and the dollar is getting stronger. So even if they raise their prices, all else equal, the dollar purchasing power sort of makes up for the rise in prices. It's just sort of something to watch.
So what you're saying is, if there was a time to do it, now's the time to implement tariffs. That's what you're saying.
I mean, I don't know that.
I'm just kidding.
I don't think that he wants tariffs. I think he wants to use it as the stick.
Yeah, fair treatment. Right. Of course, follow the rules or you're going to pay the penalty. And I can't even, I'm not smart enough or not familiar enough with the situation to say what, agreements China is in violation of, which is why a lot of the reasons they want to put,
Well, I think it's partly just opening their markets or opening. And look, Europe there's rules of what we can import to Europe, what they can't, Canada and the US. I remember there's a big dust up about maple syrup one year. There were big tariffs on maple syrup one way or the other. I didn't pull the article, but yeah, I agree. It's too much the global view, I would say. It's too much of the groupthink right now if you watch CNBC.
Yeah. Yeah.
So maybe there's some
I think it's great that you're pointing out kind of these three factors. It'll be interesting to see if the actual cost of the good to the end U.S. consumer changes.
Maybe not. Maybe not.
That's ultimately what we're talking about.
There are some changes, though, to the S&P 500, Jay. The Apollo Global Management, which I think they do a lot of private credit, I believe, and Workday are being added to the S&P 500.
I've heard of Workday.
Yeah. Like if you watch a golf match, a golf event, there are tons of Workday
one with the rock
commercials.
stars, right? Stop saying you're a rock star. That's Workday.
Oh, was that what they had Paul Stanley from Kiss in there?
Oh, they got a bunch of people. It's just plenty of rock stars.
Billy Idol, maybe.
Billy Idol
in there.
Billy Idol just stole your golf cart.
Yep. Apollo Global Management and Workday in QORVO. I'm not familiar with this company. QORVO and Amentum, which I feel like got added more recently. They're gone. Why do I bring this up? I bring it up because nobody ever talks about this. The S&P 500, when we think about the earnings per share on the S&P and the sales of the S&P, it's a living, breathing index. So members are coming out, members are going in. And what's significant about this, I didn't have time to pull the cash flows and the financials of these, but often you're replacing weaker companies with stronger companies with more sales, with more net income. And S&P earnings are aggregated all together. Everything gets put in a pot. So when we say, I think EPS is going to be $2.98 per share next year, well, companies coming in could affect that. And so I just think it's an interesting dynamic that never gets talked about, but should.
Look, I think it is certainly academically interesting to watch this, and it's why we like indexes as opposed to picking individual stocks. But look, man, like really impacting the earnings, like this one of 500 comes in, and even if its earnings were double of one of the ones that were coming out, you're talking about basis points impact to the dollars earned in the index.
Well, that's fair. But would you rather have strong companies or weak companies?
I would definitely rather have strong companies, and I want to keep losing the weak ones and adding the strong ones. But I don't want to overblow it and, say it's going to significantly impact earnings per share of the S&P.
They also mentioned that Coinbase was denied. A lot of people were hoping Coinbase got in. I believe now, I was going to say Morningstar, not MicroStrategies, MSTR, is added to the NASDAQ 100, not in the S&P 500. So that would, what's the drawdown from the top on MicroStrategy?
I think it capped out at like 4.25. Let me take a quick
I think it was
look.
5. Wasn't it 530?
I don't think so. We do trade that one quite a bit. So give me a second. MicroStrategy, the top was, drum roll, it was 543. You are correct. I guess that day it closed, the high close was 470. The day that you're talking about when it hit the all-time high, that close was under 400. So it went that day from, 540 down to 397. Today trading at 330.
Yeah.
So it definitely had a little run up ahead of steam. But look, Bitcoin sold off a little bit too from 108, but the charts don't peak on the same day. That's for sure. And look, they don't have a lot of earnings, right? I mean, they do some work, right? They sell some stuff, but they're incubating Bitcoin, whatever that means.
There's also some accounting things, and I don't even want to get into the accounting stuff. I'm not a CPA, just of how they get to report gains in their Bitcoin versus losses. And I think there's some changes coming, and that's one of the reasons why some, in air quotes, people are speculating that, well, maybe it can get into the S&P 500, which would mean it would have to be bought because the indexes. I have no idea whether that's possible or not.
You remember the Tesla story? Like for so long, Tesla was, would have been a top 10 S&P company, but it wasn't in the S&P, right? So this is not unusual for the NASDAQ, for a company to be included in the NASDAQ and be a heavy hitter in the NASDAQ, but not be in the S&P. Not the first time this has happened.
I'm going to give you a wacky prediction that's probably has no basis in fact. Bitcoin next year, 2025. I think there'll be a hack or some other development, like they'll uncover who owns the Satoshi stash that causes a problem and leads to a sell-off. Now, everyone knows that I'm a Bitcoin skeptic. So this is sort of in my own rooting interest. But I don't know, is it, and maybe I'm an idiot on this stuff, isn't it possible that something comes out about Bitcoin, or there's a problem with somebody gets a bunch, hacks in there and gets a bunch of Bitcoin? I know people tell me that it's impossible.
Hacks in there? There's no like Fort Knox. There's no safe.
Well, I don't know. I mean, what if they find out who owns the Satoshi stash?
So what?
I just think there's going to be a problem with Bitcoin. That's one of my predictions. Off the wall predictions.
Well, look, I mean, your skepticism, this rationale of, is it secure? Is it really, this blockchain thing real deal? Can it be corrupted? Can somebody replicate it and cause it to fork something different? Whatever the terms are that I'm using, all of that stuff has always been the concern about Bitcoin. I'm going to give you a concern about Bitcoin that I hadn't put together until just a few days ago, and I can't take credit for it. But Google just recently made quite a bit of an accomplishment with their quantum computing. If you recall, if you saw that news, Google went up, I think, 9 or 10 points that day. And it hasn't really, it's the ability to conduct all of these calculations that traditional supercomputers would take whatever trillions, gazillions of years to do. And quantum computing is doing it quicker. You apply that against the encryption of Bitcoin, I think that's a real potential risk here, where you can. So, you gave kind of a theoretical. I'm going to give you something I think really can happen here, is that you apply quantum computing against the encryption on Bitcoin, and now all of a sudden what you think you have safe in a wallet is not, right? That to me feels like a bigger risk. And I don't know enough about the encryption on the blockchain for Bitcoin, but, if all it takes is computer power, we are developing faster computer power.
So why couldn't they take their quantum computer, and I'm asking this legitimately, and go mine Bitcoin if they have the fastest computer in the world, and they'll corner the market on it? Couldn't they do that? Yeah,
that's the point that I'm bringing up. And I'd like somebody who's smarter than us when it comes to these topics to give us some information. But we're talking about predictions here, so there you go. I just gave you my.
I'm going to get emails now from the Bitcoin crowd. Yeah. Don't do that, Jay.
Emails about quantum computing. That to me seems like a legitimate. They should email you about quantum computing because you asked a legitimate question. So that's my Bitcoin risk prediction.
Quantum computing is really interesting related to AI, and you think about its ability to solve problems and ability to do very, very complex things. And it's really exciting, some of the stuff that's possible. So I think, all right, here's another one from me. I already said this. Amazon's going to break up its company because they need to get into the SOX index. They have the Trainian chip. So they need to spin off their cloud and AI GPU business. But I already said that last week.
You did.
Do you have any other off the wall predictions?
No, I thought I came up with a good off the wall.
I think that's a really good one.
Okay.
All right. So how much Bitcoin is left that can be mined before it gets to the limit, the theoretical limit until 2
billion more coins, something like that.
So if they have the number one computer in the world, couldn't they just corner the market on it?
I've already given you that answer. I don't know. Somebody should tell us that information.
Okay. All right. Fair enough. One of our senior trader said Russia, a coup d'etat. That would be out of left field. Maybe. I
mean, yeah. Could it be?
It's kind of happened already, though. Remember Boris Yeltsin in was it 1990? Was that 6? No. 93? 92?
No, later. It's when there was the currency problem over there, right?
It was when, remember the tanks were in front of their parliament building? That was Clinton, during Clinton's presidency.
Yeah. Well, so a coup d'etat. So the military turns on Putin.
Yeah, that's right.
Yeah. Okay. Interesting prediction to put on there. Sure, possible. You got any other geopoliticals?
Let's see. Related, U.S. does start to buy Bitcoin, and other companies like Microsoft and Amazon also start to buy it.
I mean, the U.S. is already, whoever gave you that.
They seize it. Don't they seize it for the crimes?
The U.S. is our top 5 holder of Bitcoin, the United States government. Yeah, already.
Okay. I'll leave the other one out.
Yeah, leave the other one out. Who cares if Amazon? I mean, Amazon should allow you to trade Amazon Meta in using Solana or Bitcoin if you want to purchase things. I think I told you, right? My son went to a florist to buy a bouquet of flowers for his girlfriend. He paid with Solana. So he thought it was the greatest thing ever. I was like, you could have just done that with your debit card, but yep, that is great. There you go. in Boone, North Carolina.
Well, imagine, I'm going to make this up. What does it cost in Boone, North Carolina? $20 for flowers?
It's not the third world. It's still, he spent more than $20 on flowers for his girlfriend. Let's say it's
$50.
All right.
It doesn't matter. Call it $100. It's easier from the math. So if he pays with that, and then what is this now? Solana? I don't know who that is, but let's say Solana goes up by 10.
It's like a token that you use for financial transactions.
Yeah, I'm sure it's got a great future. So anyway,
it does.
100. Let's say he pays $100 in Solana, and Solana is a 10 bagger from here. It means he just paid $1,000 for flowers.
No, it doesn't.
Or it gets
at the value at the time. It's like you're telling me that if I sold a stock at $100 and it goes up to 1,000, like I sold it 1,000.
But you're not claiming it's a currency.
I don't know why we're doing that. Who cares? I paid with it. It feels like a currency. If I'm trading corn kernels, seems like a currency.
Maybe he got a deal. Maybe it goes down by a tenth.
It did go down, by the way, since he did that.
And he paid $10 instead of $100 for his flowers. He got a 90% discount.
Solana in Boone, North Carolina, but he does.
Oh, I mean, they take it in what's not Argentina. What's
Ecuador?
Ecuador, yeah.
Bitcoin in Ecuador. Yep. Aruba. I could have paid for my breakfast in Aruba years ago, pre-COVID. I could have paid with Bitcoin.
In a present value basis, that breakfast would have been $100,000 breakfast, probably.
Amazing breakfast. The Dutch Pancake House in Aruba. If you've been there, you know what I'm talking about.
Dutch pancake. All right. Speaking of recommendations like that, what do you got, Jay?
Go to Aruba. That's my recommendation. Actually, I love going there. Let's see. Watched. So since we're talking a little bit about the pandemic today, just it's come up. Watched a scary movie called Host this week, where there is a seance over Zoom, and the movie's an hour long, just like a Zoom call would be. And they, as you can imagine, accidentally summon an evil spirit. Then there you go, over Zoom.
And you're recommending this?
I'm going to say if you feel like only watching a horror movie for an hour, then watch Host. It was not bad. It was pretty good. It reminded me a lot of Paranormal Activity, which I would give a strong recommendation to if you've never seen that. But if you've never seen that, then you don't watch horror movies. That's all there is to it. But if you're looking, that's a great movie. This one is like that.
Horror movies are you almost need to see those in the theater.
I'm going to tell you something. Paranormal Activity, you watch in your house, you're not sleeping with your lights off that night. I'm just telling you.
Okay. I don't know if I've seen that or not. I'm going to have to look it up. This week, all right, I'm going to give a shameless plug because people are making New Year's resolutions. And I co-wrote a book called Effortless Public Speaking, How to Speak Stress-Free with Confidence and Make Speaking Your Competitive Advantage. Myself and my co-author, Liam Sanford. It's available on Amazon. I think they've lowered the price. Effortless Public Speaking. It's a good gift for people as well. There's a Kindle edition. So that's a shameless plug. And of course, they should also get Buy and Hedge and your book and my investing book, which is Broken Pie Chart. Those are available as well on Amazon, and you can request it. I've had people tell me they go into their local Barnes and Nobles and they'll order it because it has an ISBN number.
I've never seen either of our books in a Barnes and Noble, though, by the way. But that's okay. You can still get it. It's on Amazon. It's there.
You know what? When I came out, I went to my local Barnes and Nobles and I ordered it. So every book has an ISBN. If you turn it over and it's got the barcode. Yeah. As long as it has that, you can order it. So,
Seriously, do you think our audience would appreciate if you and I did a book together?
I think they would. I think they would. We've been teasing it.
I'd love to hear about that.
Yeah, we've said email me if topics. We have an outline. The writing is commencing.
Yeah, organized, but it's not too late to have your topic included. There's going to be 8 chapters on Bitcoin failures.
No, it's not. Kidding. No, we will have. We'll tease it. We're going to have the debate between the Bitcoin skeptic and which obviously is me, and you're going to take the other side. So we'll have that in there.
I wear that hat.
2025, at some point, the book will be out. Is that fair?
Sure.
Okay.
Get your ideas in now.
Yeah, that's right. And I'll just mention, I saw the movie Whiplash with Miles Teller.
Oh, very good.
Yeah, wasn't that a good movie?
Yes, very good.
Who is the actor's name? He's been in he used to be in Law and Order. Here, I'm looking it up right now. J.K. Simmons.
Yeah, he's in a lot of stuff. He's, well, why don't you describe it, right? You brought it up. Why don't you give a quick 2-second summary of it?
It's an elite music school in New York City. Miles Teller plays a jazz drummer, and J.K. Simmons is the leader or conductor of the an elite jazz band, right? And he's very, very tough on players. And if you think Bill Belichick is a tough coach, he exceeds Bill Belichick. And Teller's a young player, so it's sort of the relationship between those two. They both need each other, but both sort of are antagonists too. But really good movie.
Each other. Yeah, but it's great. It's good movie. Whiplash is a good movie. Agreed.
That's on. I think it was on Netflix. I saw it on. So there you go. All right, and then the other thing too is Jay. Should we mention? I think you're going to get demoted to semi-permanent co-host.
I'm going back to semi. Yeah, my last one for a little while.
Yep. So we'll have some other guest host on. I might do one on my own, but Jay will be back, but needs to take a couple weeks off. No bad reason, by the way. We should mention.
Yeah, really. Don't let anybody read into it.
No.
Oh, that's good stuff. No, that's good.
No.
It's time to change it up for Derek in a second voice. I think it's exciting. It's been an honor to be doing so many of these, Derek. So appreciate you letting me tag along for as long as I have. Yeah,
of course. So probably taking off January, and then we'll look to pick it back up after that. But yeah, we'll have some. So this way, people don't email me, because every once in a while, I mean, I've never taken off a show. That would really mess people up if I ever took one off. But yeah, so when you aren't on, sometimes they say, "Wait, when are you guys? You guys are really good on together." So, but yeah, so a couple weeks. I'm
really busy writing our book. That's not it.
No, that's not it.
But
all right, Jay, anything else we need to cover?
No, that's great. I think 2024. Folks recognize what a strong year that was. Interesting year. Don't know what 2025 will hold, but buy and hedge, protect yourself, manage your risk. The only thing you can really control is the risk you take. So keep that in mind.
You buy the risk. Wasn't that a quote in your book?
I don't know.
When you buy a security, you buy the risk.
Oh, you're buying risk. That's what you're doing. That's right.
You're buying risk.
You're buying risk.
Unless you're buying Topcon rubber futures. Don't do that. Please don't do that. All right, everyone. That's it. We're calling it. See you, Jay. Thanks.
Bye.